Investment banking. You've probably heard the term thrown around, right? It's always connected to these massive deals and high-stakes finance. But what does it actually mean? Well, today, we're going to pull back the curtain and demystify one of its most powerful engines, the world of debt capital markets.
So have you ever stopped to wonder how a giant tech company builds a brand new global headquarters? Or how an entire country pays for something huge like a high-speed rail network? We're not talking about a small loan here. We're talking about raising billions, sometimes tens of billions of dollars. You can't just walk into a local bank for that kind of cash. So where on earth does that money come from?
Well, that's where these specialists come in. The best way to think about investment banks is as the master architects of the financial world. This image here shows their job perfectly. They are the bridge, you know? They connect their clients, like huge corporations and governments who need money, to the massive pools of cash that are out there in the global markets.
All right, so here's our game plan to break this all down. First, we'll cover the absolute basics of what investment banking even is. Then, we'll look at the two main ways companies get their hands on money. From there, we're going to do a deep dive into debt capital markets, walk through how a deal actually gets made from start to finish, and finally, look at the internal structure of the bank that makes the whole thing tick.
Okay, let's start with that big picture. Because at its core, the job is surprisingly simple to understand, even if the day-to-day work is, incredibly complex.
Let's use a really simple story to explain it. Picture a brilliant brewer. She's got a recipe for the best beer in the world, she's got the skills, but she has zero money to actually build a brewery. Now, across town, there's an investor who's sitting on a pile of cash but has no new ideas. They absolutely need each other, but they have no idea the other one even exists.
And that, right there, is the job of the investment bank. They're the matchmaker. At the end of the day, investment banking is just about bringing together capital demand, that's our brewer, and capital supply, that's our investor. And this connection, this matchmaking, is literally the fuel for the entire economy. Without it, so many great ideas would just fizzle out.
So really, when you boil it all down, an investment bank's work comes down to two main things. First, there's advisory. This is when they give strategic advice on huge moves, like one company buying another one. And second, and this is our focus today, is capital raising. This is the nuts and bolts of helping their clients get the actual cash they need to grow.
So when a company decides, okay, we need money, it immediately faces this fundamental choice. There are two main roads it can go down, and the one it picks has huge consequences for the future of the business.
This slide breaks down that choice perfectly. On one side, you have equity. Let's go back to our brewer. This would be like her selling a slice of her brewery, a share, to an investor. That investor is now a part owner. They share in the profits, but also the risks. On the other side, you've got debt. This is more like our brewer just taking out a big loan. She gets the cash, but she has to pay it back, plus interest. But here's the key difference. She keeps 100% ownership of her brewery.
And that right there is the number one reason why a company chooses debt. For so many founders and CEOs, the whole game is about growing the company without giving up control. As this quote says, debt is the way to get the money you need without diluting ownership or, cutting your pie into more and more slices for other people.
Okay, so now we get why a company would choose debt. So let's zoom in and really get to know the specialized team that makes these giant deals happen, the Debt Capital Markets Group, or as everyone calls it, DCM. So the DCM team, these are the absolute experts in structuring and selling debt. It's their job to advise clients on how to borrow huge amounts of money from the market by issuing things like bonds. And they mostly work with really big, stable clients, what the market calls investment grade. That just means they have a great reputation and are seen as a really safe bet for investors.
And the DCM team has this whole toolkit of different products they can use. The most common one is the corporate bond, which is basically a formal IOU from a company to an investor. Then you have government bonds. You've probably heard of U.S. Treasury bonds. Well, that's what those are. They can even help a city raise money. And something like commercial paper, that's just a really short-term loan, often for day-to-day business costs. Every product is custom fit for what the borrower needs.
And this is where it stops being some abstract financial concept and becomes the real world. I mean, when you drive on a new highway, or you see a brand new school being built, or fly out of a renovated airport, there's a really good chance it was all paid for by something called municipal bonds, or munis for short. This is the stuff that DCM teams help build all around us.
So we know what DCM is, but how does a deal actually go from just being an idea to suddenly being billions of dollars in the bank? Well, it's a super structured process that happens in a few key stages.
This flowchart here gives us a great bird's-eye view of the whole deal lifecycle. It looks pretty straightforward, right? But trust me, each one of these little boxes represents months and months of incredibly intense work, from that very first pitch to the final signature.
Let's break it down. First up, you've got pitching. This is basically a competition where banks fight to get hired by the client. If they win, they get the mandate. Then it's on to preparation, where they create all the documents, like the CIM. That's just a fancy term for the super detailed sales book for the deal. After that comes marketing, where they go out and sell it to investors. Then it's diligence and negotiation, hammering out all the fine print. And finally, signing and closing. Pop the champagne, the deal is done.
Now that very first step, the pitch, it all hinges on this one critical document, the pitch book. And let me tell you, this is not your average PowerPoint presentation. This thing is a deeply researched, beautifully designed marketing weapon. Its only purpose is to convince the client that this bank is the absolute best choice to handle their multi-billion-dollar deal. The whole battle is often won or lost right here.
So we've followed the life of a deal. But here's the thing. The deal makers in DCM, they don't operate in a vacuum. To really get how a bank can handle these enormous transactions safely, we need to zoom out and look at the bank's entire operational structure. So basically, you can think of any large investment bank as being split into 3 distinct but totally interconnected parts. And this isn't just for, keeping things organized. It's a critical system of checks and balances that makes sure the whole place runs like a well-oiled and safe machine.
Okay, so here's how it all breaks down. First, you've got the front office. This is where our DCM team sits. Their goal is simple: generate revenue. They are the deal makers, the client-facing people, working those legendary 80-plus hour weeks. Then you've got the middle office. Think of them as the brakes, the risk managers. Their job is to make sure the deals the front office is doing are actually sound. And finally, you have the back office. This is the engine room, the people in accounting, tech, and operations who make sure the lights stay on and everything runs smoothly. And all 3 of these offices create this vital, synergistic loop. See, the front office can't do deals without the middle office managing the risk, and neither of them could function for a second without the back office providing that essential operational backbone. It's a really elegant system of creation, oversight, and execution.
So, there you have it. We've pulled back the curtain on the financial architects who are literally building the world around us, funding the companies we buy from and the infrastructure we use every single day. The next time you see a headline about a huge corporate deal or a new public project, you'll actually understand the complex machinery that's working behind the scenes. So I'll just leave you with this question. Now that you know how it all works, how will you see the world a little differently tomorrow?